Welcome to Taking Stock. I'm Amanda Lang. Coming up on the show, instability in the banking sector has some wondering if central banks might dramatically change course. Are lower rates on the horizon? And air travel is increasingly difficult in Canada. We are sizing up the problem. Plus, the pandemic put a dent in our economy. Actually, it's a hole. We'll dig through it. That's all ahead. First, for the week that was in business, time for the briefs. The second largest U.S. bank failure in 20 years rocked markets this week as Silicon Valley Bank's wrong bets on interest rates come home to roost. Smaller U.S. bank Signature Bank was also taken over by regulators. A less official bailout came as major U.S. banks deposited $30 billion into First Republic to help shore up its balance sheet and avert a similar crisis. The turmoil has some investors betting the U.S. central bank may stop raising rates in order to keep other banks from hitting the same snags. If there was hope that inflation had cooled in the U.S., taking some of the pressure off of the Federal Reserve, its central bank there, they were dashed by a read this week showing prices are still elevated at 6% in February, which could leave the Fed little choice but to raise rates even further to bring inflation back to its 2% target.
Inflationary pressures in the U.S. are pretty strong still. And we do believe that the Fed cannot afford to stop hiking at this time.
Volkswagen confirmed this week what has been rumored for months. It will build electric vehicle batteries in St. Thomas, Ontario, creating a few thousand jobs once the plant is up and running in 2027, and establish a foothold for Ontario in the North American EV supply chain. What hasn't been announced is any government subsidies used to draw the factory to Ontario.
There were going to be $300 billion spent in new EV facilities globally, and not one penny of it was coming to Canada. And in the last 24 months, we landed $17 billion here in Ontario alone.
A First Nation-owned liquefied natural gas terminal was greenlit by the province of BC this week. The $3 billion Cedar LNG terminal is to be built in Kitimat, BC, and is owned by the Haida First Nation. The terminal met the province's environmental assessment, but still has to clear certain hurdles around greenhouse gas emissions, as well as dozens of other commitments. Like other planned LNG terminals, Cedar is still many years away from being a reality. The federal government will spend almost $76 million to tackle a huge backlog of air passenger complaints. Meanwhile, the federal regulator issued 30 penalties to airlines, including fines for violations of passenger rights. Sunwing will pay the biggest single fine, $126,000, for flight delays over the holiday season. Critics argue the fines are too low to be meaningful for the airlines. And those are your business briefs. No one said fighting inflation would be easy, but perhaps for some U.S. banks, no one ever said it would be this hard. Now, some investors are betting that rates not only may not rise further, but central banks could be forced to cut them sooner than they wanted. If that sounds illogical, it's the kind of logic the market loves. J.F. Perrault is chief economist at Scotiabank. J.F., thanks for being with us.
Thank you.
So let's just start here with this notion of rate hikes necessary to fight inflation, but painful. Can it be the cure that kills, in that old expression? Is it so much medicine that it actually is going to really hurt some, in this case, banks and other businesses? And we should add households.
Well, I mean, it's possible. I mean, you got to keep in mind why central banks are raising interest rates in the first place. They're raising rates to slow inflation, obviously, but that mechanism through which you slow inflation is actually slower growth. So central banks have been trying to engineer a slowdown. You can argue they've been trying to engineer a recession. Now, you know, recessions are painful. We think this will be mild, but they're still painful, and then things happen and accidents happen. And, you know, what we're seeing in the U.S. banking system maybe is an indication that, you know, those impacts are starting to be felt in a more tangible way than we've seen for many, many, many months now.
And so if you had to guess about the path of rates, let's stay in Canada here. When the Bank of Canada next makes its decision next month, what's your expectation? Can they stay on hold as they have been, or could they keep raising, or are they even maybe encouraged to cut? I don't think we're there yet, but what do you think they'll do?
I don't think we're there either. Hey, listen, I mean, the reality in Canada, as it is in the U.S. and as it was in Europe yesterday with the European Central Bank this week, inflation remains a problem. Right? Inflation in Canada is 5.9%. Target is 2%. We are nowhere near where we need to be. Now they're on the right path, but to cut rates now when inflation is still a big problem is, would be quite extraordinary in my mind. So we don't think that's going to happen. We don't think it's going to happen later this year either. In fact, as we think about it, the short-term, risk to the rate side in Canada and the U.S. is more that they would do more rather than less, right? If inflation doesn't come down more rapidly, if inflation starts to pick up like it has in the US, for instance, you're talking about a central bank Canada that might actually need to do more rather than less.
And I guess we should also acknowledge, Jeff, that this could be a new normal. In other words, this may not just be up and down again, back to where we were. We could actually settle in at higher rates. Should people prepare for that?
Absolutely, right. And you got to keep in mind, it's normal for folks to look at the last 15 years and say, well, that's kind of history. That's how things normally are. But they're not, right? We know, and Bank of Canada will say this, a neutral policy rate for them, so a neutral rate setting, is in the 2 to 3% range. Now, that's not where rates were, 10 years ago or 15 years ago, but that's where rates are likely to settle when we're all done with this. So you've got to build into your plans. You got to think that in a couple of years, when things are back to normal, hopefully, and inflation's under control, you're looking at a policy rate in Canada of 2 to 3%, not 0, not half a percentage point, not 1.5, but so something substantially stronger than what we're used to.
Jean-François, great to have you with us. Appreciate it.
Thank you.
Jean-François Perrault is chief economist at Scotiabank. Coming up, flying the unfriendly skies, an industry that's still reeling from pandemic risks alienating its customers. Stay with us.